The Australian government is considering making one of the biggest tax changes to property profits in 30 years. In this video, I'm going to break down what the tax is, how the current Labour government is proposing to change it, and how you should be positioning yourself and your property portfolio for the change. If we are meeting today for the first time, my name is Glynn, a multi-millionaire property investor and owner of The Edge Property Buyers. So when it comes to consider selling an investment property, the first conversation you should be having is with your accountant to see how the sale is going to be taxed and how it will affect your profits. The main tax on property investment profits is called the capital gains tax, and this is what Labour are looking to change. Capital gains tax is a tax you pay on the profit made when you sell an asset for more than what you paid for it. The tax was introduced in 1985 by Paul Keating, who argued it was unfair that those who owned assets and made a profit didn't get taxed, while productive labour was highly taxed, creating higher inequality. Originally, the capital gains tax was indexed to inflation, and you were only taxed on the real gain. So let's look at an example of this. If you bought a property for $100,000 and sold it 10 years later for $200,000, that is a roughly 7% compounded annual growth rate per year. Now, if inflation averaged 4% per year in that 10-year period, you would only get taxed on the 3% real gain per year. So your 7% growth rate minus that 4% inflation, the difference is then added to your personal income and taxed at the marginal rate. As you can see, this method was complex and people were finding it complicated to understand and difficult to adhere to. In an effort to simplify the tax and encourage long-term investment, John Howard changed the capital gains tax in 1995 to what we currently have in place today. Capital gains tax in its current form taxes the profit made when an asset is sold. And for individuals and some trusts who hold the asset for more than 12 months, only 50% of that profit is included in taxable income. So let's look at an example of this. Let's say John bought an investment property for $1 million and paid $50,000 in stamp duty and other upfront costs. That means his full cost base for the property is $1,050,000. Years later, he sells it for $2 million. His total capital gain is $950,000. Under today's capital gains tax rules, because he held the property for more than 12 months, only 50% of that gain is taxed if he held the property in his own name or an eligible trust. That means instead of paying tax on $950,000, he would only pay tax on $475,000. This is then added to his taxable income and taxed at the marginal tax rate, with no adjustment for inflation. Now we have established what the tax is today, let's look at what Labour's proposed changes are. Firstly, they are considering reducing the CGT discount from 50% to 25% or 33%. The other option to have is to remove the discount altogether and just get taxed on the full profit. There has also been some talk about going back to indexation, but that seems unlikely given the complexity of the tax in that form. So let's look at some of the positives and negatives around the change before getting into what it means for your portfolio. So some of the positives that proponents of this change in the tax would outline are that it will increase tax revenue and make wealthier individuals selling assets pay their fair share and use that tax collection for things like Medicare or budget repair. Some have pointed to intergenerational fairness as a way of redistributing wealth across generations. People have argued it would reduce speculation and demand from property investors on established homes in particular, making it easier for first home buyers to get into the market. On the negative side, detractors to reducing the capital gains discount have pointed to the fact that the fastest way to get less of something is to tax it. In this case, it means less new properties purchased by investors, and that will hurt the supply side of housing in the market that is chronically undersupplied. Investors make up roughly 1/3 of the market, so disincentivizing them could lead to less rentals and ultimately higher rents. It also discourages long-term investment across all asset classes, not just property. The government says that it will look to save around $20 billion per year, but if they did drop the discount, investors likely would not sell their properties. They will instead just hold on to them and borrow against them or wait until they retire to sell them at a lower marginal rate. This might mean less supply of houses on the market, and you could save significantly less in tax than anticipated. But what does this mean for property investors? Not much really for someone like me who is a long-term value investor and uses property investment as a vehicle to hedge against inflation and capture economic value and increase in M2, which is the overall money supply, over time. Our strategy is to buy high quality properties in high demand blue chip locations in Australia's major capitals. The properties have a strong outlook for capital growth. Changes to negative gearing or the capital gains discount does not change anything in our strategy. Taxes are going to come and go, they will change with various governments, but the strategy of building wealth with high quality pieces of land essentially and holding them for decades is timeless. If you're looking to purchase your next investment property, you can click the link in the description below and book in a discovery call with me.